Welcome to Mining Now. I'm your host, Jared Downey, and joining me is Gowdy Molina. Hello, Gowdy.
Good morning.
Good morning. It feels like it's been a little while since we've shot a Mining Now.
You know what? Yeah, I think it has been a little while.
Because we had just a barrage during the summer. It was just like one after the other.
Yeah.
Yeah, and then we had
It feels like I haven't been in the office for a really long time.
Well, we had a couple reschedules, and it happens.
Yeah.
What
I think it's also been other, like you said, other shows and that kind of thing. So it's been a while since Mining Now, but
we got lots coming up, and we're going to kick things off with Paul Nielson. He's the head of project development at Waterton, Global Resources Management. But we're going to also have a bit of a special focus today. CIM is putting on their Capital Project Symposium in March. So that is it's 27th to 29th. So they're going to pack a lot of information into those 3 days. So we're just going to sort of tease out some of the things that they'll be covering and also get Paul's expertise on some of the topics. Before we do that, Gowdy, we have to hand things over to sponsors. So take it away.
Okay, so today we've got Fuller Brothers. Fuller Brothers Inc. has over 59 years of tire industry experience as the world's leader in providing non-hazardous, non-toxic products that reduce tire management costs for a diverse range of customers. The acknowledged formula developers of the globally recognized Tire Life. Fuller Brothers also produces other quality products such as PSF Plus, PSF, LubeZit, Tire Cream, Dripless Tire Paint, Omega Tire Repair System, as well as select tire service tools and tire painting equipment. For more information, you can visit fullerbros.com, or you can also call toll-free 1-800-547-7785. Fuller Brothers, we have the inside covered. We also have Holly Frontier Lubricants and Specialties, which includes the Petro-Canada Lubricants brand. Petro-Canada Lubricants products and services are proven to maximize equipment performance, productivity, and overall savings. From heavy-duty engine oils to hydraulic fluids, automatic transmission fluids, and gear oils and greases, Petro-Canada Lubricants is committed to delivering innovative solutions that deliver value and keep businesses moving. They have dedicated technical expertise, knowledge, and know-how to help customers in the mining industry operate smoothly with improved equipment, reliability, and performance. You can learn more at lubricants.petro-canada.com or contact them at 1-866-335-3369. Next up, we also have Savanaugh Equipment. Savanaugh Equipment supplies new and used mining equipment around the world, from placer to underground to ore processing plants. They have gold concentrating tables, trommels, and mineral jigs in stock now to take advantage of the high gold prices. You can visit them at savanaghequipment.com, where you will find more equipment every day. And of course, we've got CIM. CIM is partnering with the Mining Industry Human Resources Council and the Prospectors and Developers Association of Canada to present the Mining Needs You virtual career fair on November 8th and 9th. This 2-day event runs from 10 a.m. to 7 p.m. Eastern Time. That's 7 a.m. to 4 p.m. Pacific Time, both days. Registration is now open and free for job seekers, and only $300 for exhibitors looking to hire. This national career fair is an opportunity for students and job seekers to apply for exciting work placement and job opportunities. It's also a chance for employers, recruiters, academia, and other sector representatives to network. You can find out more at miningneedsyoucareerfair.vfairs.com and help spread the word across social media by using hashtag MiningNeedsYou. And last but not least, we've got PowerZone. When you need a specialized team of world-class engineers for your oil and gas pipelines, dewatering, or any fluid handling needs, you want to visit powerzone.com. In addition to the inventory of rebuilt pumps, motors, engines, they also have an amazing team to design and engineer your systems, no matter the challenge, no matter the location. Get in the zone with PowerZone. Visit them at powerzone.com.
Hello, Paul. Welcome to the show.
Yeah, thanks for having me, Jared.
Yeah, it's great to have you. We're going to cover a lot of topics. This project development topic, capital project, is, I think it's an understatement to say it's an important thing. So I'm glad you're here to talk us through it. I've touched on it on, certain different shows, but I obviously don't have the expertise to unpack it. So glad you're here. Before we get into it, can we just give just maybe a little bit of your background and Waterton and just some context to the audience?
Sure. Yeah. So my name's Paul Nielson. I'm a metallurgist by training, and I'm the head of project development at Waterton. Waterton's a private equity platform that invests in mining. We've got $1.75 billion under management, and the portfolio is largely constructed to be open pit heap leach gold projects in Nevada because they're low risk and Nevada is a great zip code. But beyond that, we've got a care and maintenance copper concentrator in Arizona that we're bringing back online, and a greenfield nickel sulfide project in Quebec. So basically, our model is when the sector's out of favor, we're buying, and then we take these assets private. We give them the care they never had by the previous owners to really step through them diligently. And then eventually they'll go back on the market at some point to get our investors the best return. So I've been in the business for about 20 years. Started my career in operations in northern British Columbia at gold and base metal mines. And then I got into consulting for the excitement, really. And I've worked on concept studies through commissioning and construction on a bunch of projects all over the world. And so I joined Waterton in 2017 to head the project development function and make sure that all our assets are advancing and adding value.
So you have a bit of experience in what we're going to be talking about.
Yeah, it's just
little
a
bit.
tiny bit. In my role in consulting as well, I had business leadership pieces, which actually adds a lot of insight to some of the common misalignments that owners and EPCM companies have. So we can talk about some of these things as we go. Yeah, for sure.
I just got to ask a very flat out question that, it's actually making quite a bit of news, and but historically it's been quite a challenge to get these projects off the ground. Do you think that's going to change because of the sheer demand that we have coming down the pipe?
So yeah, look, mining projects are really, really hard. And that isn't to say that projects aren't hard in other industries, but when you layer on all the levels of complexity in mining projects, the deck is really stacked against you. Each deposit is unique in terms of its geology, metallurgy, geotechnical, hydrological characteristics, so you need to do a lot of really complex multidisciplinary work to actually understand how the project is going to behave and get enough confidence to bring it into production. The trend across the globe is deposits get lower and lower grade simply because the good ones are mined. And that means you need to make high volumes. And so there's been a huge trend to large projects. And with size comes complexity, just in and of the fact that these projects are large, they are complex. If you think about it, you're say trying to do one garden bed in your backyard, you can wing it. Some things are not going to go according to plan and you can adjust on the fly. But if you think about trying to install garden beds, to cover several football fields, you got to have a really good plan and you got to execute that plan to the T. And if something hits you unexpectedly, it's going to be really hard to recover. So that's kind of what you see in the complexity of scale. The other thing about mining, of course, is you don't get to choose where the mine is. The deposit is where it is. And that might be, I spend a lot of time in the Southwest US, but, there are mining projects all over the world. And with those things come, a lot of challenges, particularly when it comes to ESG and being a good neighbor. And then you add to that the volatility in the commodity prices. If you look at the last boom, copper went from $2 to $4, then back to $2.
Mm-hmm.
Pretty hard to make money in that kind of environment, and let's not lose track of that. That's what mining projects are about. They're about making money. So from the start, it's a really tough slog. And what happens is when times are good, there's all these projects happening, and when times are bad, not many projects happening because it's very hard to act countercyclically. But that means that the staff in the industry fluctuates. So when everything's going, you're doing all these projects, they're big, they're complex, and then the people you have, it's really hard to hold on to a really experienced team. So all this just adds to a very challenging execution environment. You look at the trends in the world you look at battery metals in particular, that's, where everybody's focus is these days. And if you look at copper, nickel, things like that, to meet even the most conservative demand projections for the electrification of the supply chain, the number of mines that you're going to have to bring online to meet that is jaw-dropping. And it takes a decade to bring a mine on. There's going to be a lot of demand because supply is relatively inelastic, whereas demand moves pretty fast.
Yeah, it's, and it's, I was actually reading through your notes going before the interview, it's something I know, but it sort of just struck me is that, yeah, when the pricing is high, it still takes 10 years. So you can't build a mine really based on a cycle. I mean, of course, the experts like yourself in the industry know that already, but it's you're not waiting. You always have to be moving forward in an industry like, let's say, in the auto industry in like a 2008 crash. The prices of a truck didn't fall in half. They just
Right.
dialed back supply. Whereas the mine, you're still in the middle of building a gigantic mine as you're watching the prices sink. And of course, investors are sitting there going, oh, they're not thinking 4 years. I mean, some of them are, but a lot of them aren't thinking, oh, well, it's okay. In 4 years, it should come back.
Well, and the reality is, once you're operating, you've sunk the capital. You're now committed to operating, and when there's so much revenue volatility, it could. And I use the example of copper. Copper is not even that volatile by metal standards.
Right.
If you look at molybdenum in the last boom, $6, $40, back to $6. Now it's trading around 20, but there aren't too many primary molybdenum mines that haven't been on care and maintenance at some point in their life, simply because the commodity price is so
Right.
volatile. So it's a super tough business that way, and most people don't appreciate how those structural challenges influence what can
Yeah.
be produced.
Yeah. What with this symposium that CIM is putting on, which it's one of these, I don't get to every one. This is one of them that I'm going to be at for every minute of and my team is going to be there too, taking notes. What are some of the things that are going to be being unpacked?
Yeah. So look, transparently, because of all those factors I talked about, and lots of other stuff, the mining industry's track record in delivering projects, particularly in the last boom cycle, was pretty shoddy. Maybe 1 in 5 projects was delivered on time and budget, and the rest were over and long. But this conference isn't meant to be as an industry, we're not very good at this. This is meant to be a collaborative conversation amongst everybody who makes projects a success. And again, it's another piece of complexity. It's not just owners, it's not just service providers, and it's not just financiers. It's the conversation between all three of those groups, and those people all speak different languages. The way a financier thinks about technical risk is different from the way for example, an EPCM consultant thinks about technical risk, and then an owner's team is going to look at it differently as well. So it's meant to be a collaborative conversation, so that we can share best practice, look at what's worked, looked at what hasn't, what delivery models we've seen in the past, where delivery models are trending, how you align all that kind of stuff. So this is the second edition of the Capital Project Symposium, and the first one was all virtual last year. This one's meant to be in person, March 27th to 29th, 2022 here in Toronto. And like I said, it's really about getting everybody together to discuss the different lessons learned, and talk about what new ideas we can come up with to make sure projects get delivered safely and successfully. There's regional differences in how projects are conceived and implemented across the world. We're here in Toronto, and it's the Canadian Institute of Mining, Metallurgy and Petroleum, but all the same, there's centers of expertise in South Africa, in the UK, in Australia that have a significant influence on how projects get executed worldwide, and those people need to be part of the conversation. It's going to be a hybrid event, in person, so we can get those conversations between sessions and across meals, and at the pub in the evening, if that's what folks are going to do. But at the same time, we want to be able for people to participate remotely, because the reality is with the world we're living in, sort of coming hopefully towards the tail end of this pandemic, things are different, and we need to be flexible.
Oh, so there is going to be a virtual component as well.
There will be, yeah. We're looking at a hybrid model, so that some presenters can contribute without having to hop on a plane, because the reality is, some places, Australia, you're free to leave, but you got to be gone for 90 days if you want to come back. So if there's a lot of great expertise coming out of Australia, and a lot of really good different ways to think about executing projects, and that is a pretty big barrier for those folks to come participate.
Yeah, no, I'm glad to hear that you're doing that, because it's Yeah, it's there's this uncertainty, but I think not I think I've been taught I talk to so many people sort of every day within the industry, and I mean people want to get back out, but they also don't want to they don't want to overplan. They don't want to overcommit now to
Yeah.
something because it's just there is this uncertainty. So it's nice to have that hybrid, people that are out in the East Coast, but if you're out in the West and you're just unsure, or, can I send my whole, do I want to send 3 or 4 people, or maybe I'll just book one, all those options. It's really nice to have it. Can you sort of break down the sessions? Obviously we're going to leave it, a lot of it for the actual event. But I think it is good for people to know sort of how it's going to be divided up over those 3 days.
Sure. Yeah. So there's four main streams that we're dealing with. The first is about taking your project from the studies through the construction decision, and how in that you advance. There's a lot to unpack there, and I'll sort of tackle these one by one as we go here. The next session is on financing, both for project development and construction. This is a place, honestly, me personally, before I came to work in private equity, I didn't understand the money side of the business that well. I was a pure private or pure projects person, and projects people and money people don't speak the same language, and they don't think about things the same way, and there's a bridge to cross there. The next session, the third one's on project execution case studies, which is fairly self-evident. People sharing best practice, what worked well, what didn't, what they've learned, all this kind of stuff from major mining projects worldwide. And the last piece is on contracting models, and really getting to win-win and alignment between parties, which is a long overdue discussion in our business. And I'll talk a bit more about that one as we go here.
Yeah. Okay. Let's go back to the first one, the project development. Can you start to unpack that? I saw this. I'm going to skip down to a third, design philosophy. I saw a note. Sorry to take this away from you, but Kia versus Bentley, which is funny. I like that.
And look, that isn't to denigrate Kia. They make great cars. And
Oh, it seems like you love them.
Yeah, look, I'm in project design philosophy. I'm definitely a Kia person.
Okay.
But look, the reality is there are lots of different approaches you can take to designing a project based on the life of the project and the commodity cycle we talked about earlier. If you're a base metal company, base metal projects tend to have longer lives. They tend to be lower grade, long life, big volume. Precious metal assets tend generally to be shorter life assets. So that really changes what you do from a design perspective. If you're a copper producer, you probably think about a project in terms of mine life divided by the project's payback period. And the reason you think about it, and you want that number to be as big as possible, because that tells you you're going to have cycles that are up and down. But when things are good, you're making money hand over fist. And when things are bad, you're scraping by. The bigger that number, the more number of times you're going to make money hand over fist over the life of the asset. If you're a precious metal producer and you've got a 10-year asset, say the first year and a bit is getting the thing into steady state, then after that, you've got 8.5 years to make good money. So what that means in terms of how you design your project as you're taking it through the study. The best example is if you look at how BHP designs projects and Rio Tinto, they design those things to be super maintainable and super operable, which is what every project should be if money isn't an object. They're dealing with really long life assets where you can pay for that. And then on the other hand, you look at like true bootstrap operations where, yeah, it would be nice to have all those things, but you can't afford it. So what do? You squeeze the snot out of the design and make it so it will deliver the business model and nothing more. No bells, no whistles. You call it zero-based design. You start with no standby pumps, no spares for anything. And then you look at it from a risk standpoint. Where can I spend money to de-risk, as opposed to starting with the big thing and working your way back? And look, that pervades itself through the whole project design process. You can, again, the way to think of projects is this. There's if you think of a theoretical project that has it doesn't really matter what it is. About a quarter of the capital cost will be the tagged process equipment. About a quarter of the capital cost will be the bulk commodities like concrete, steel,
Right.
Piping, electrical cable. Then about a quarter of the project will be construction labor, and about a quarter of the project will be all the indirect costs associated with executing the project, housing, transport, freight, logistics, all this kind of stuff. But then if you look at what those things are, the quarter of your project that's tagged equipment, that's your cash flow, right? That is what provides your business. And if you look at where that tagged equipment and the bulk commodities are real things in the real world, the labor and the indirects are really just servicing the bulk commodities and the process gear, right? So what it ends up happening is if you allocate the time and those costs to where they truly go, so the indirects and the construction labor to the bulks and to the installation of the bulks and the installation of the process equipment and the mining equipment, you end up with the process gear. Your flow sheet, your pay is about a third of the costs, and installation thereof, and the bulk commodities are about 2/3 of your cost and installation thereof. So the way to think about it is that third, that's your business, you don't squeeze there. But then the 2/3, that's just a money pit, and your whole job through engineering and design is to mitigate the size of that money pit.
When I was, I don't know how old I was, maybe 22 or something. I was when I was sort of first, I'd been around it in the sense of, a little wire brush on some old gear, that kind of stuff. But when I came into the sort of industry and was actually starting to network and get to know people, there was a lot of talk, and someone listening to this might correct me on this, but there was a lot of talk about new versus used equipment. Like now
Sure.
investors didn't want to see you putting used equipment on their sites and things like that, which is my background. My family comes out of the used equipment world. So I remember that being, that was an alarming thing for me to hear at 22. So I was thinking, oh no. But is that still the case where you have, or is that even a real thing? Now it seems to me like from what you're saying, if you're looking at a project, you want it to match up. You want whatever they're investing in to match up with what they're trying to get processed. Not so much, well, just categorically, we're going to have the most updated equipment in the globe on a project that might be around for 5 or 6 years. Is that kind of what you're saying?
Yeah, look, it all depends on the specific circumstances of the owner, what they can afford, what the project needs, what the project can afford, the market capitalization of the company, because that affects how much you can spend, right? The thing about new equipment is that, say you're buying a new pump, that for the first year, 2 years of that pump's life, it's going to run as new before you kick the crap out of it in operation, right? It's going to be new and it's predictable. Whereas used gear, you don't know exactly how or when it's going to need maintenance and how it's going to fail. So that's the challenge with used gear, is that it's less predictable. And in the end, for a mining project, uptime is the thing.
Right.
So the uptime is less predictable. But again, there have been plenty of projects in all over the world that have been very successful using used equipment. So again, you wouldn't expect someone like mega cap company like BHP or Rio Tinto to pick up used equipment and install it. But again, it comes down to the context of the company specifically. There are plenty of case studies where companies haven't been able to make the decisions they wanted to make for lack of money, but nonetheless, they've been successful in the projects in the context that they've had. So it all ties into the same sort of questions around not just what's the design philosophy, but the design philosophy comes from how are you going to get the money to build the mine, and that's a function of your market capitalization and your partnerships and all this kind of thing. And when it comes to taking a project from the studies through construction decision, it really matters who you are. If you're a single asset company, your job really is to get that project built and put forward reasonable investment expectations. So a potential investor can say, okay, I'm going to put in this money, I'm going to get that return. In a mature major mining company, it's not the same question. because they have a number of projects that are competing for capital within the same organization. So then it becomes a risk equivalence question. And how do you put those projects on the same basis? And, looking at different commodities, different technologies, different locations, it's exceptionally complex to balance those things out so they're equivalent risk. And all those things have knock-on effects on how you design, how you implement your project. So again, these are super complex topics that will provoke some pretty good discussions there.
Yeah, well, like I said, I can't make every single one, but this Capital Project Symposium is one that I'm going to be at with a notepad. I want to talk a little bit about I think session 2, you've already sort of, touched on them a little bit, but the development and project financing. And I want to talk specifically about, I always like when you can sort of put two things beside each other to sort of get perspective. And there's sort of that, the Aussie mentality and the North American mentality. And I want you to unpack, again, I'm sure it'll be unpacked more at the symposium, but I'd like to touch on a little bit on the show, because I think it's an interesting perspective.
Sure. So look, there are a lot of small gold mines in the Western Australia gold fields that North American companies never would have built. Just wouldn't have done it. And the Aussies did, and they were super successful building a whole bunch of projects which are arguably should never have been built. But they were, and they were successful. So the question is how? And there's a real difference in how the capital markets treat projects in Australia compared to how they treat them in North America. In Australia, companies are broadly valued based on cash flow. North America, they're broadly valued based on net asset value, or NPV. So North American companies are always talking about PNAV multiples, so price meaning market cap to the net asset value. Whereas in Australia, it really is about free cash flow, price to free cash flow. And that changes how you think about a project, because the Aussie mentality is basically, what can I pay for? What can I spend? What can I do? And then turn that into some cash flow, and then reinvest that cash flow into a bigger thing, and then reinvest that cash flow into a bigger thing. And eventually you get to the big project. Whereas the North American developer approach is more, okay, this is the best value version of the project from an NPV standpoint, but then it takes a really big bite to get there. I don't have any strong biases as to which model is the right one, because again, it's really project and context specific, but there are very different philosophies there. And again, it changes how you look at things. I think that manifests itself in development projects pretty significantly. Aussie companies have the larger Aussie delivery houses have been more comfortable taking project execution risk over the last sort of 20 years than North American companies have. So they'll do fixed price lump sum turnkey delivery of projects, whereas the North American houses have been a bit less game for that approach. And again, it has huge implications on the cost of a project for an owner. If just pick a hypothetical $100 million capital project, don't know what it is, it doesn't matter. But if you're going with an EPCM project execution model, your cost of capital, again, I'll just pick a nice easy number, is 10%. Whether it's actually that or not, it's not that important. But so $100 million project, your lender is going to insist that you have an overrun facility of probably 30%. So now you're at $130 million at a 10% cost of capital. Whereas for an EPC project, which is fixed price, where the delivery risk is transferred to the contractor, your execution contractor, their incentive is that if they find a way to do it cheaper, that's money in their pocket. You're paying the same value regardless of whether it's over or under. So they're incentivized to do it cheap. But then the lender looks at that and goes, right, that's 100 million and the number is 100 million. I don't need you to do the overrun facility. And because that risk is transferred, the cost of capital is half as much. So from an owner's perspective, $130 million at 10% versus $100 million at 5%, those are really different projects. And it all comes from the philosophy of how you're going to execute. Both of those things, if you're doing an EPC fixed price contract, if your contractor is incentivized to do things cheaply, then you have often an operability issue that comes with that. So you
Right,
have to find
yeah.
a way to appropriately balance that. But these execution models, these aren't trivial things, and they span many different disciplines, and that's why we need to be talking about these things, because it really trickles down, and how you get the money, who you get the money from to execute your project. These are all really relevant topics.
Do you think it's going because of the increase in demand, though? Do you think some of that Australian approach is going to trickle over into the US and into Canada and down into the Americas?
Yeah, and it's, in fairness, it's not just an Aussie approach. You've seen it with pretty successfully in companies in Africa, based out of South Africa as well. And some of those companies are traded on Canadian public markets. A really good example of this would be the Atlantic Gold Moose River Consolidated project, which was eventually acquired by Santa Barbara. And look, that project was built on a shoestring, and it delivered its business model. And you look at it and you go, wow, that thing is lean, and that's fine. That's what it took to get that project built, and that is 100% the right model. So yeah, I think, look, the reality is, I don't think generalist money has yet understood the enormity of the challenge that it's going to take to electrify the world, and the enormity of the challenge in that material supply.
Yeah.
There was an interview with one of the founders of Tesla recently. He was talking about how the other auto manufacturers weren't really understanding the implications. They're saying, yeah, buy some nickel, make some batteries, and his question was, yeah, but they haven't thought through the supply chain yet. And so people are starting to have those conversations and think about the supply chain. Where are you going to get your nickel? It's a great question. Where are you going to get your copper? The copper demand over the next 10 years is going to be astronomical. And where it's going to come from when it takes 10 years to get a new mine into production, from 10 years from discovery to production is an efficient timeline. There are mines that happen faster than that, but most don't. So it's a pretty significant challenge, and I think you will see enough variation in the challenges of projects and the context of the individual companies executing those projects, that you'll see a huge variety of delivery models. You'll see North American companies take Aussie delivery models. You'll see more collaboration, because the world, despite the pandemic sort of making the globe less accessible, it's also shrunk us in terms of how we have these conversations and how we share best practice, I suppose.
What was I going to ask? Do you think? Yeah. Oh, I was going to. I don't expect you to have this data just on hand, but these projects that are funded based on cash flow, do they have a history of being able to scale up later, though, to reach full potential? Or do you also, I would assume part of the reason that it doesn't get implemented in some places, because then there's that risk that it just ends up staying that size of project, and it really, you don't actually fully realize the asset potential.
Yeah, and that can be, usually once, the funny thing about capital projects is that the initial capital spend is usually the hugest hurdle to get over. If I look at our own portfolio, we have some brownfield assets that we've restarted, and if they were new mines being built, we probably wouldn't have done it. But because the site was captured, because there was a footprint there, the incremental capital was pretty reasonable.
The roads are built, and
exactly. Yeah, all the facilities are there. It's got power, it's got water, all this kind of thing. And those are significant costs, especially if your mine is particularly remote. So once the capital to build your mine is sunk, the calculation is different, because then honestly, that money's behind you. You however you finance the mine to get it built, you have to make good on those commitments, obviously. But from there, the calculation, if you just do a forward-looking piece with debt service, or if you sold equity or a precious metal stream or what have you, those obligations carry. But then you're doing a forward-looking calculation, and the capital's behind you. And what that almost always says is do more.
Yeah,
if you can.
No, that's a really interesting point. Yeah. And I think of it, I mean, not even in the production world, you start off with with a little camera and getting stuff out the door, get people moving, and then you can make much better cases for scaling up because you have a little bit of data. You have something that actually exists. I guess that's why I've had people on the show, and I got to get some more on actually talking about these mobile plants that are being used. I mean, that they're a great opportunity to get a project underway, but then scale up at a later date. I'm sure in Australia, I think they're huge in Australia.
Yeah, so our projects are, you know, I work on a lot of heap leach projects, and heap leach projects are really, from a processing standpoint, you're basically making a big pile of rocks and irrigating it with solution, and then you've got a really small processing plant to extract the pay metal from that solution. That they're not complex, but you know, they're successful because they're cheap to build and they're cheap to operate. That's really, you know, the story of heap leaching, particularly in the Southwest US, copper in Arizona and gold in Nevada. But you know, those projects are successful because they are what they are, and the operators and the builders of them understand the risk profiles of those particular types of assets. And you know, there's a huge difference between, you know, a 2 million ton a year small crushing heap leach project and you know, 20-30 million ton a year copper concentrator. You know,
Right.
people look at those and go, mining project. No, that, I mean, they're miles apart. And oftentimes people don't appreciate the challenges that come from those differences.
And I'm assuming that is actually that just right there. Is that something that's going to be covered at the symposium? Just understanding the distinction between these projects.
Yeah, definitely. A number of the speakers will be touching on that. In you know, that'll be a pervasive issue across all 4 sessions. You know, if you're thinking about, you have to know the risk profile of your project from a design perspective. It trickles down into how you finance it. That'll be touched on for sure in the case studies. And then the other thing is the contract models, how you align interests and execute from there. It's yeah, it's a critical part of it.
Going back to that, I know we're not going to go into the project execution. If there's, are you going to have, are some of the speakers going to be from these successful projects and actually be walking people through how detailed is it going to get from a technical standpoint of getting these projects actually in operation?
Yeah, so look, this is the only conference globally that is solely focused on project execution and capital project delivery. There are often sort of side conversations or some presentations or a stream at other events, but this one's really focused on it.
Which is great, by the way. It is. It honestly, it is great that they're, because I've been the person in the industry that didn't understand what was going on, and it's very overwhelming when you just, okay, this is what this is about. I'm just going to learn this and actually go forward with it. You know, we've got some new team members coming in. Sorry to interrupt you, but I just
No,
want
it's
to
fine.
say, I think it's fantastic that CIM is doing this type of thing because it's just so important. People need it. New people coming in the industry need very specific type of information. Not just they also need the big events, but they need this specific stuff so they can walk out of there going, okay, now I get this part. So
Yeah.
anyway, sorry to interrupt you, but I think it's important to know.
All I was going to add to the point is just that in you know, the third session is all case studies, so it will be project
Great.
specific presentations by the people involved to talk about what went well, what didn't go well, why didn't it go well, what have they implemented as learnings on their other projects in the future. You know, really pull back the hood and share some of those things. You know, I guess the other thing, you know, talking about the complexity of project delivery, the number of different things that can kick you in the face on an execution project, the one couldn't make a list. You know, you just have volumes and volumes of all the things that can go wrong, because again, with the complexity of the size, the unique nature of every deposit, and on and on and
Yeah.
on, all those things. But it is nonetheless very informative and enlightening, because you can see, okay, so these folks had this challenge. I see an analogy to my project. How are we going to manage that risk, or how are we going to capture that opportunity within our specific context? And this is always the challenge. It's tempting to paint with broad brushes, but each project is unique and needs to be thought about as a unique thing. And usually when people get away from that, that's where challenges creep in.
I don't think I think I'm gonna butcher this question, but I'm gonna try to ask it. These these projects that are trying to get off the ground, all these check boxes that they need to hit. And we're the fourth session is contracting models, a hugely important topic, obviously. It how disruptive, again, not a great way of asking this question, but how disruptive is not following through with some of these, because like you said, there's so many things that can go wrong. The projects that are good, the good projects that there's good profit, there's good
Mhm.
there's a good plan in place. Do they still find a way to go ahead, even if they do miss something? Are they able to correct it? Are investors forgiving, or do these little disruptions, can they topple an entire project, even if it's a good one?
Well, I mean, they can and they do. Yeah, awesome example is Pretium's Bruce Stack project that underperformed market expectations. But if you look at what that mine is today, they're printing money. They're, you know, they they deliver. And again, I don't have any inside information. I just, as someone who's always really excited about what's going on in this industry, you look at Bruce Jack. Yeah, they said they were going to be 400 odd thousand ounces originally in the feasibility study, and they're delivering 300 odd thousand ounces a year. They're delivering 300,000 odd ounces a
Right,
year in,
right.
in the bottom half of the cost curve. That's a smoking gold project. But because the expectations were set higher, those, they were in the penalty box for quite some time. And, they've dutifully worked through those challenges, and done what I think is a pretty good job of dealing with all that. But again, because the expectations were set where they were, it's a challenge for them. But in a vacuum, it's a great project still. And a great project is a great project, even if it is challenged. The trick is that over time, as all the great deposits are mined out, you're getting to more and more challenging projects, deeper underground, riskier jurisdictions, more complex processing methods, narrower margins. All these things make it harder and harder to be successful in projects. So it's not just that the industry has to clear a bar for a constant set of complexity and difficulty. It's that the bar keeps getting raised, and we have to raise our game too.
Right. Yeah, it's I guess probably this contracting models. I mean, the the location is the, I don't know if you'd agree that it's the biggest challenge. It's definitely the thing that I hear about the most, because we've got the technology, we've got the processes, we've got know how to collect data now. But at the end of the day, if a community says we don't want this,
Yeah, look, uh, it, social license to operate is the thing for a mine. Mines, when they go poorly, are an eternal monument to failure. When
yeah,
they go well, they are transformative. But there's a lot of really tough complexity that comes with that. As a mining company, you don't want to be in the business of doing government and providing basic services for communities. At the same time, you want to be a really good member of the community, and you want to be supportive to the host community that has you there. So there are a number of exceptionally challenging lines to walk. But in the end, it just comes down to, you have to have social license to operate. And that really means being a good neighbor. It means being a good partner to the communities that you're involved in whatever shape that takes and whatever is important to that community. And there are lots of places where it's exceptionally difficult, because between sort of local government, regional government, national government, those don't speak with the same voice necessarily, and they're not necessarily aligned, but you have to have everybody on board. So they're really, really complex issues. And to the contracting models piece, the mining projects are complicated because of everybody that participates, the owners, the service providers, the financiers, and the communities. And getting the interests of those folks aligned is really, really hard, and takes I mean, a gargantuan amount of effort. If you look at what happened, my previous parts of my career, I was worked in APCM for 14 years and in various roles. I was part of contract negotiations and ultimately coming to deals on how we were going to execute these projects. And there was a broad trend over the last boom, sort of 2005 to 2015, of just straight risk transfer. The owners would be like, okay, this risk goes on to the contractor. Fine, but what often that did as a consequence is it caused behaviors that were the opposite of alignment. So what was good for the service provider was bad for the owner, and good for the owner, bad for the service provider. And that's kind of poisoning the well from the start of a project. Companies don't do projects, people do projects. And it's the experience and the expertise and the trust in the project team that gets these things done successfully. So, where there are different interests and those interests aren't aligned, in the end, the contract is going to win. If you want to work in a certain way, but the contract says you just have to exchange letters, well, then in the end, you're going to end up exchanging letters because it's a business. Again, great example would be, if you look at, a pie chart for a project's capital cost. For simple numbers, let's say engineering, procurement, and construction management is about 10% of the total pie. Most EPCM companies, if you look at their financial records, they have a net margin of around 10%. If their margins are diluted by a bunch of volume, it might be lower, but typically 10%. So what's the first thing? Owners often beat the snot out of engineering contractors to get better unit rates. So say you get a 10% savings on 10% of the project. That's a 1% size, 1% of your project capital cost has been saved. If you were to align interests on it, you say, okay, EPCM consultant, here's the size of the pie, shrink the pie. And they're going to find more than 1%. Obviously, you have to do it in a way where the interests are aligned, and again, where it doesn't become inoperable and it doesn't create problems. But in aligning interests, if you're an owner, you're set to spend $100 million on a capital project, and someone finds a way to do it for 80. Well, all of a sudden you have $20 million you otherwise weren't going to have. And if it's a $100 million project, again, using those 10% numbers, 10% of that's EPCM, so that's 10%, or 10 million, and their margin on that is 10%, so they're making $1 million.
Right. Yeah.
If they find a way to deliver it for 80 million, toss them 5 as a bonus. Their margin just got multiplied by 5. That is a huge business for them, and you have $15 million that you otherwise wouldn't have had. Right. So it's finding those alignments between what matters. The best way to execute a project is for what's good for everybody's business to be aligned. Yeah. And the contracting models getting to win-win is about exploring those conversations and pursuing those avenues such that a good project success is a profitable project and a successful project by whatever success criteria are defined by all the different participants, so that everybody comes away getting what they need out of it. And that, like I said, that takes a ton of time, a ton of effort, because it's easy to say, this is just the standard contract, instead of having the decision makers sit down and say, right, what's a win for you? This is the win for us. How do we make that happen? It takes work, but I think it's pretty critical to being successful in project delivery.
Yeah, that's a little bit of a Japanese business philosophy. That sort of approach of making sure every level across the board and down is everybody is getting an advantage out of it.
Yeah.
I was actually wanting to just get your opinion on something, because this is sort of a thing that I think, for lack of a better word, a fear that I have, and I think it's a legitimate one, but I'd like your perspective. I am concerned that if we do not start to get these mines online in the way that they're supposed to get done, safely, social license, and I'll also highlight social license in particular with this leading technology and the support of governments, local and federal, and all these layers we need, that the demand, when it really hits, and I mean really hits, and it will. I mean, it's not even people that are just pro mining that say that there's a demand. We're pretty much all on the same page on that. Maybe one thing that we could all agree on in this world, that there is going to be a demand, that it will then get pushed through, and then that social license component will then start to be challenged, or the importance of it will be minimized. Do you think that's a legitimate concern?
It's an interesting question. I think the biggest challenge there is that, so look, the cause, if the demand is happening and the supply is slow to respond, what that means will be high prices. And that's what you're seeing across the world. Like if you look at the past year, we had that horrendous spike in lumber prices, just based on supply chain disruptions. But again, supply demand imbalance, right? And you look at the last 6 months in fossil fuels with all the ESG investment and long term, 100%. Let's get away from burning dinosaur bits. It's horrible for the environment. The reality is, most of the world's power still comes from burning fossil fuels. So when there's underinvestment in those things, you have a supply demand imbalance and the price goes nuts. And the truth is that price going nuts hurts regular people.
Yeah, that's who it
Right?
lands on.
100%, and that's where it hurts. And when regular people, the population of anywhere, like you think about it, just if all of a sudden your gas bill gets multiplied by 5, at some point, you're going to say, I can't afford this. This is a problem. This is a societal problem that needs to be fixed. And the reality is, people of the world, if they demand change, change will come. So I would be very, very surprised if to your point of sort of resource extraction getting rammed through. First, on the investor perspective, there's more ESG mandates out there that restrict how and where people can invest.
Yeah.
So those folks are not going to support companies, and it's a huge capital base. They're not going to support companies that are ramming projects through.
Right.
And I think the public will in those places to oppose rammed through projects would be devastating. And you would end up with no social license. And without social license, you can't operate a mine. You just can't.
Right. So really but in essence, what you're saying is the problem is that, so that has been put in place, which is a good thing, but it's still, if the demand increases, it's going to land, it's, you're going to go buy a car and it's like, there's going to be a whole new type of price tag on it, essentially.
Well, yeah. I mean, look, I needle my parents because they talk about when ice cream was a nickel, right? When I was a kid, ice cream was $5. It's not crazy to think that over the next 20 years, we'll see another multiple of the same amount.
Right.
And if you look at the amount of debt in the world, not to get on an economic pulpit, but the only solution to it is inflation. It's the only solution. Because otherwise, which is to say, yeah, $88 trillion of debt worldwide. The only way to make that manageable is to make $88 trillion not that much money. And the only way to do that is through inflation.
Right. Yep. No, no, there's a lot of truth to that. No, it's an interesting, I mean, of course, that sort of came out. There was a surprise topic, but I think it is an interesting topic to discuss, because I hope at very least that there will be sort of a shift to saying, okay, if this mine is doing it right, let's greenlight this. Like, I hope that is somewhere where we get to, like 10 years to get a project off the ground when 5 years ago you knew that it could be going. I mean, it's absurd.
Yeah, part of the challenge. Look, I have great empathy for the regulators, because how do you know what's real?
Yeah.
You're not technical. And again, when mines fail or when mines contaminate, it's an eternal monument to failure. And yes, they're closure bonding and giving the governments the ability to close mines if the company becomes insolvent. Sure, but that doesn't change the fact that there is risk on the part of of civil society in having mines put in their backyard. And that has to be done in a way that is appropriate for everyone. Like, if I'm honest about that 10-year project development thing, much of that is the technical work just to get your handle on it. And for sure, permitting in some jurisdictions, permitting takes forever. But I don't begrudge those jurisdictions for being careful, especially, again, to the complexity piece. If you're a regulator, how are you going to make sense of the detailed, subtle, nuanced technical work that comes into defining the risks of a project? I mean, it's a tough gig for them too. It's a tough gig for everyone. So the only way through that is collaboration. So if civil society says we need these mines, let's work together and find ways to expedite this process. I think that might be a natural outcome.
Yeah, and I'm sure one of the things that are going to, we've talked about this on the show. I've had some great guests on talking about, when you do that social engagement and start getting that social licensing, not waiting until it's, you've done all this other work and now you show up, Indigenous leaders talking to me about, they show up with it already pre-made. Well, this is what we're doing. Do you like it? It's like, well, you maybe should have talked to us 3 years ago and given us a chance
Yeah.
to build it with you. And I'm sure that's going to be discussed in the symposium, because I've talked to, I mean, I don't even know the number, but it's been a lot of people who said that that's a major issue. It's just that conversation started after so much stuff was already done. So of course you don't feel, if someone just shows up and says, well, this is what I'm doing, you don't feel like you're a part of it.
No.
Here's a little bit of money and we'll have a couple of discussions and hopefully we can green light it there. It's like, I'm not doing that. Why would I do that?
So within our organization, we have an environmental and permitting team, which knows the Southwest US cold, and they understand how to work with the regulators and what the regulators are concerned about. And, my background is technical. The number of things that I look at and go, oh yeah, that's a throwaway detail. And they're like, this is a showstopper.
Yeah,
And meanwhile, other things that I see as a monumental change, they look at as like, whatever, it's rounding error, it doesn't matter.
different
Nobody cares.
languages that people speak.
100%. And we're coming from it. And look, those are, this is two groups of people within the same company effectively coming from the same place. So, if we're misaligned, I can only imagine how it feels to be the communities. If you're not doing your engagement and working on your social license from the start, you're missing the boat, because there can be things that are meaningful to your host communities or to society on the whole that cost you almost nothing to implement and really matter to them. Why wouldn't you do it?
Yeah. It's well, we're gonna wrap this interview up, but are you speaking quite a bit at the what is sort of your role in the session?
So my role is I'm pulling together and sort of chairing the session on the development and project financing. So I've got my thoughts about what topics we should be discussing, and I'm working with the rest of the organizing team to pull together the right speakers to make sure that that's a robust discussion. So basically, I'm part of the organizing committee for session 2, and we've got obviously we have regular meetings and pretty good discussions about what topics should be on the table, who should we be inviting to speak, what are the right perspectives to share, to make sure that we're covering the breadth of discussion and really facilitating good conversations, because a good conference is, in the end, it's just a really good conversation.
Yeah, and it's going to be great. And it's March 27th to 29th of 2022, of course. It's going to be at the Marriott downtown.
Correct.
Toronto,
Yeah.
right.
Yep.
Yeah, we're going to have links, everything. So to anybody watching, it'll be easy to find out. And can people already start registering for it and everything like that?
Absolutely. Yep.
Yeah. Okay. Thank you very much, Paul. Hopefully we'll get a chance to chat. Hopefully I can get to the event in person, and things are even more open, and yeah, it'll be great.
Fingers crossed on that.
Okay. Thank you very much for joining the show.
All right. Thanks a lot, Jared. Take care.
Okay. Well, I think all 4 of those sessions, well, I see why they're doing a 3-day.
Yeah, there's a lot in there.
Yeah, you can't pack all that in one day.
Oh boy. Okay, Gowdy, where can people follow, subscribe, share? We're going to put all the links for the CIM for the symposium up, but where can people follow Crownsman?
Okay, so definitely subscribe to our YouTube channel. Follow us on Facebook, LinkedIn. We're super active on there. excuse me. You can also contact us, info@crownsman.com, to suggest a guest, or if you'd like to be a guest, yeah, definitely contact us because we are getting closer to the holidays and we're booking out fast.
November is booked.
Yeah, so
November's actually
start
double booked.
booking now. Yeah, start booking now for the new year. Is
Well, we got a
kind of where
couple.
we're at.
We got a couple. So I think we got like 4 spots left in December. They'll be gone by today. They'll be gone by today, though.
I know.
Okay. Thank you very much, Gowdy. Thank you again to Paul. Thank you to Angela and Christopher and the whole CIM team. We love doing this show in collaboration with CIM and sharing so much information about the mining industry. And a huge shout out to you for watching. Thank you, and see you on the next episode of Mining Now.